thing. We know that there's a number of competing events like this, so we appreciate it that much more that you actually decided to attend this presentation, especially those of you that are online as well. It seems that the trend nowadays is for people to attend online as opposed to the personal touch. We still think that the personal touch does make a difference, but in future, as I said, we prefer then doing the hybrid type of thing, the personal as well as the Teams version, such that people can decide which one to attend. As I stand here, first of all, I must admit that I am deeply humbled. I'll tell you a bit later because I just need some time to compose myself because of that very function. But in the meantime, while I'm composing myself and just maybe getting into shape, we have a number of better speakers that I am. Firstly, Annabelle Bishop, you know her, Chief Economist of Investec, and we're also always looking forward. The one thing that I'm concerned about is, there's no increases in taxes, so I'm not sure where we get the money from, but we'll ask Annabelle for that. So she starts. She's unfortunately online because, and then thereafter, Gerard will mention a few good things about that. It seems that it's just good things about that, and no increase about the VAT rate, which everybody expected, but in an election year, that's impossible, I think. And thereafter, I'll then see what I can do at the end. But thank you so much. We really appreciate it. And before I forget, afterwards, there's some cocktails there in that boardroom over there, so just don't leave. I actually prefer just going there directly as opposed to the presentations, but we actually have to get this over. So thank you so much, and over to you, Annabelle.
Yes, hello everyone. I hope you can all hear me and I hope you can see my slides. I've asked them to put them up on the big screen in front of you. I'm not sure if it's come up yet. Should I proceed or should I wait for the slides to come up?
I think if we can wait a second, there you are. Yeah, we've got it on. Thank you so much. Yes.
Perfect. Okay, great. So I'm going to give you a quick rundown of the economy first. I'm going to dive into the budget. I'm very happy to take questions afterwards as well. But let's just see where we are with South Africa and the global economic performance, because of course that informs very deeply into what government can do in terms of its finances. We expect GDP growth at 0.5%. For last year. Government, in fact, revised their figure down to 0.6%. So they're in line with us. That's important because it's a base of which economic growth is calculated this year. And this year, we're looking for 1%. Government's been a bit optimistic and revised their figure up to 1.2%, but we'll unpack that later. I think what is quite key is that we still have a very weak economic environment. Inflation, we believe, will actually come out at 4.5% this year. And of course, that is very, very important because that means that we can enter into interest rate cuts in the second half of this year. However, as you saw from the start of my presentation, at a 0.5 or 0.6% economic growth rate, that is exceptionally weak. And that resulted in revenue underruns. It resulted in higher projections of debt, borrowing in the budget, but of course as well, it also has a negative effect on investor sentiment. And we know that a lot of the factors which are driving the weak economic growth environment obviously comes from the problems at Eskom and Transnet, the crime, the corruption that we've seen. Of course, we've seen the grey listing as well. But let's not forget, the global economy was weaker last year. We saw weak global growth. We saw a significant negative impact on commodity prices. And of course, when you find yourself in a situation where commodity prices are not performing well, that has a negative impact on the government revenue of a commodity exporting country. South Africa obviously being a commodity exporting country. So all of these factors have contributed to quite poor government revenue projections, government debt projections, and of course fiscal revenue expenditure projections as well, but also of course fiscal deficit projections that we saw in the MTBPS. I think just before we go into the budget, just to have a look at the global global economy. Of course, the rand was weak last year because we are a commodity currency as well as a commodity exporting country as well. Global financial market sentiment was also risk averse, and that drove rand weakness, particularly amongst emerging market economies. While we have seen some expectations of the United States moving into an interest rate cut cycle, every time those expectations are pushed out or delayed, if you will, that then obviously results, as you would anticipate, in a weakening in the rand as well. So, of course, that has also been one of the contributing factors to currency weakness last year. Okay, if we just go into the macro figures, I just wanted to put the figures up for you in a table just so you know what we're talking about. We had stronger economic growth in 2022. We had that weakness in 2023 we're talking about. We expect to see some improvement going forwards, but not a rapid improvement. Whether you forecast 1% for economic growth or 1.2, 1.3, as National Treasury does for this year, it's pretty much of the same. It means a weak environment. It's not one in which you make a big dent in unemployment and reducing unemployment. And of course, as well, we know that we're going to continue to see load shedding, hamstringing South Africa's economic performance. If any of you would like this presentation afterwards, we can always get it to you through CDH, because we obviously also have the quarterly figures and projections here as well. But let's just move on into inflation quickly, because I know that's often a key concern. What's inflation going to do? What is the South African Reserve Bank going to do, and when will we have our interest rate cuts? You can see here that we are looking for a 4.5% outcome for this year. Government's looking for a higher outcome, and that's one of the reasons they delay the interest rate cuts. Interestingly, the Reserve Bank both sets the inflation target in terms of whether it can or cannot cut interest rates. So it both sets the inflation forecast and, of course, as well, also then has to meet it. So these factors do mean that if they put through a 5 or 6% inflation forecast for this year, it means that the interest rate cuts are delayed. If we've got a 4.5%, we really think that inflation will drop down to the midpoint of the target range in about July. The Reserve Bank has said that it needs to stay at 4.5% for a sustainable period and actually be expected to remain there over the medium term as well before they cut interest rates. So you can see our Reserve Bank has actually been quite hawkish. Here's these quarterly forecasts I was telling you about as well. Just bear in mind that while that was our inflation forecast, there is obviously concern about oil and fuel prices when they go up, when obviously you do see higher international oil prices as we're experiencing at the moment, then you have a risk of higher petrol prices. We're looking for another petrol price increase in March of about 125. Why does that matter? Because it places upward pressure on inflation and further delays interest rate cuts in South Africa. Okay, so interest rates here, we can see we do expect to see a cut this year. You can see we dropped down by 50 basis points. The following year, you can see we expect interest rates to drop down by a full 1%. So yes, we expect an improvement in the economic growth environment in South Africa, partly because interest rate cuts occur. Here's just the rand as well, for anyone who wants to go into deeper areas in the rand. But I think let's move on towards the budget. Just before we get there, you can see obviously that we have seen higher bond yields. One of the reasons is that there has been a deterioration in government borrowings. This is important because we're going to have a look at government borrowings next. When government borrowings rise, when government takes on more debt, when it issues more bonds, it means that the supply increases and, of course, the price then falls. So there is that inverse relationship which remains between the yield on government debt and, of course, its price as well. So you can see that as we have obviously seen fiscal health weaken over the years, we've obviously seen the debt yields increase as well. So that's really a concern. If we have a this is the credit ratings, but if we turn to the budget now, you can see the budget came out better than expected. What do we mean by that? Well, if you have a look at the budget figures itself, these are them here, the 2024 budget, you can see that's the projection of debt, this black dotted line. Now, the one above it was what was projected in November. Markets were unhappy with the November medium-term budget policy statement. It came out much higher from a debt projection perspective. That's credit negative from a credit rating perspective, and there were worries. We've seen it reduce now. And how did government do that? How did government get its projections down? And of course, as well, the debt for this year. Government actually expects that this current fiscal year, 23-24, debt will actually come out at 73.9% of GDP, below the 74% 4.7%. That was previously estimated. So you can see a better projection for this year, a better outcome. Still high, still well away from the 60% that is needed for emerging market economies to actually see sustainable debt, but of course not as bad as was previously projected. So what government did is it utilized its gold and foreign exchange contingency reserve account. It's got about 500 billion in there. There was quite a big profit that came through, which is part of that account. And of course, as well, as a consequence of that, they drew down 150 billion. The rand depreciation had caused the profit. And this drawdown that's planned over 2024, 25, 26, 27 will actually result in a lower borrowing requirement. So the good news is that government didn't use the drawdown on current expenditure, such as higher salary and wages for civil servants, etc. But what they actually did is they used it to look at pushing down the debt. You can see it's not terribly different from the 2023 budget, but obviously there are still concerns. There's worries that we find ourselves in a position, of course, where we are still removed from that 60% mark, no matter which projection you look at, which is seen as a sustainability for emerging market economy. So that, of course, was the good news from the gold and foreign exchange contingency reserves account. If we move forwards over here, you can see the metrics of the debt as well. Medium-term revenue was raised a bit. You can see because they pushed up their GDP growth forecast. Expenditure was increased a bit as well. On the positive side, another positive, they're looking for a primary surplus now in their projections. What is a primary surplus? It basically just means that you find yourself in a situation where if you take the difference between your expenditure and your revenue, and you take out the servicing of debt, your interest rate costs on repaying debt, then you actually are in a positive situation. You're earning more revenue than you are spending. So this is something which government is now projecting for the medium term. It helps with fiscal consolidation, and it is also as well one of the reasons why we say the budget was better than expected. On the tax front, no major changes occurred at all. And of course, what that really meant was that when you have a shortfall of 15 billion, you can very easily raise that. And it's actually happened a number of years before as well, a similar figure, by just not adjusting for inflation. So if you go through the year and we experience inflation of maybe 5%, you do tend to see your salary and wage increases potentially pushing you into a higher income bracket, resulting in you having to pay more tax. If government then adjusts those tax brackets and moves them all up by 5%, so you still stay in the same tax bracket you were previously before you got your salary and wage increase, then of course they did an adjustment for bracket creep. They did not do an adjustment for bracket creep this time round, and as you can see in the bottom table, that is why they did not raise. So that is why they raised the enough money that they needed and did not need to raise taxes. So we found ourselves in a tax increase-less budget. No hikes in VAT, no hikes in income tax. That doesn't mean there weren't some tiny little hikes, and of course we all expect to see that sin taxes increased, and that is your increases in alcohol and of course tobacco products. They do increase the taxes there. There were some changes on the carbon tax front, but in terms of the major large tax generation areas, there wasn't a move on that front. So I think the important point as well, before I just move off the fiscal ratios, is that they also didn't change the actual budget deficit. The budget deficit is different to the primary deficit. The primary deficit, remember, they don't include debt servicing costs, and the budget deficit, they do. So you can see that 4.9% of GDP switches you from a positive to a negative. That just shows you how much South Africa uses its tax revenues to actually pay its debt. And in fact, one of the themes running through the budget was this concern, using very high levels of debt servicing in South Africa, which crowds out spending in other areas as well. So I think, those really are some of the key points I wanted to chat to you about. If I could just get to my next slide, my last slide. And the budget did not see a bailout for Eskom. It did note that Eskom's prior announced debt relief program is underway. From a Transnet perspective, they increased their guarantees in their debt. That means that they can borrow more debt with government guaranteeing it. You can see that the budget, of course, as well, did show some areas where there have been improvements in electricity generation in South Africa. Solar rooftop generation for households at 5.2 megawatts, just showing you, in the absence of the solar usage, how much worse load shedding would be in South Africa. And of course, as well, looking forwards now, the further renewable energy capacity construction is expected, really in the region of about 7,000 megawatts. This is now industrial sector generation, which could come onto the grid, onto Eskom. But of course, the private sector solar rooftop build could also continue as well. I think it's quite important to note that government is worried about the fiscal position of state-owned companies, even though the private sector is stepping up and providing some electricity, helping out with Transnet and some of the issues, there still remain burdens, both on government finances and in turn on economic growth. So of course, that is actually the worry there as well. The usage of gold and foreign currency contingency reserve account, as we know, resulted in government not actually seeing the same fiscal slippage, the worse debt projections that we saw in November last year. Instead, we saw an improvement that I talked to you about in the front. So overall, we believe the budget is better than expected and really did make the most of a difficult environment. I don't know if there's any questions. Oops. Okay, if there's no questions, then I'm going to sign off. If anyone would like to send me a question, you're very welcome to email me. And of course, as well, if you'd like my presentation, we can PDF it and send it to you. I'm sure you can get those details through CDH. Thank you so much.
Thank you. Thank you so much, Annabelle. We really appreciate that. And thank you for making this impressive presentation. It will take us a few days to decipher and understand, but thank you so much. We really appreciate it and you highlighting the issues. Thank you.
No, it's an absolute pleasure. And if anyone wants to be added to my economic distribution list to receive my research, you're welcome to send their email addresses to me as well.
Thank you. Thank you so much.
Thank you very much. Bye-bye.
Good afternoon, everyone. I must say, a lot of that went right over my head, but what I got from that is more good news than bad news. From a value-added tax perspective, there has been this year quite a lot of proposals, much more than what they were in previous years. If I could just start off with the collections. The collections, as they indicated and have been revised this year, is 445 billion rand from collections from VAT, which is about 25.7% of the total VAT collections. And I've just drawn a comparison in respect of the VAT collections in prior years. And as you can see there, it remains around about 25%. And in fact, if we go back to 1991, when VAT was first implemented, the VAT collections as a percentage of total collections generally remains around about the 25%. In the 2021 year, that was the first fiscal year after we had the hard lockdown in COVID. The VAT collections during that year was slightly above the 25%. But I think that is more, it's not that we collected a lot of VAT in that year, it was just because the income that was collected from personal income tax and corporate income tax was lower in that particular year. As you can see as well, from 2021 to 2022, there's been about a 60 billion rand additional VAT collected during that period. Then in the next year, about 40 billion rand. And from last year to this year, only about 20 billion rand additional VAT collected, which is effectively just, the inflationary increase in prices, not particularly additional spent or consumption. If we turn to the proposals in the budget, there are a few that are quite important, and then others that are less important. But let me deal with everything just for completeness' sake. Well, firstly, they indicated that pre-cut and prepared fruit and vegetables, that has never been the intention to zero rate these products. So the zero rating will be clarified that it does not apply to these particular products. As far as rental stock is concerned in relation to low-cost housing developments, particularly for rental, I think this is a much more important amendment that is announced here. We don't know which way it will go. But just to give background and context, if you develop low-cost housing for purposes of selling that houses, you get a subsidy from the Department of Housing, and that subsidy is zero rated, which means that you can claim the input tax deduction on the development cost. Now, and that is in terms of particularly zero rating under Section 11(2)(s) of the legislation and Section 823, subsection 23 of the VAT Act. Now, these sections have been amended quite a number of times over the years, and currently, as they read, it effectively includes both rental stock as well as the development for sale. Now, the issue is with regard to the development of the low-cost housing or rental units for rental, is that the developer develops and then rents for approximately 30 years to qualifying individuals with an income of less than a particular threshold. Now, in terms of the legislation as it reads currently, the subsidies were zero rated for both these types of developments. And it seems now that the zero rating in respect of rental stock will be taken away. Now, although the rental of housing is exempt for VAT purposes and one shouldn't generally be entitled to an input tax deduction, the issue is here that it is quite important to develop these rental units in order to alleviate the housing burden that we have in this country. So if the zero rating is taken away, that means that the developer is not entitled to an input tax deduction, which will obviously increase the cost. We don't know if the subsidies will increase by an equal amount, and whether this will apply retrospectively, because certain projects have already been completed. So that will be a disaster for those projects if they have to now repay the VAT. Just from an administrative perspective, non-resident suppliers of ships, aircraft and rolling stock under a rental to a South African entity, previously, before an amendment to the legislation, they were required to register for VAT purposes unless they had a ruling that they were not entitled or not liable to register. And then subsequently, the legislation was amended to say that where you've got a non-resident that lets ships, rolling stock and aircraft to a South African resident, that they don't need to register for VAT in South Africa because on the basis that they don't carry on an enterprise here. Now, some of those entities that were registered before the legislation amendment now wants to deregister for VAT. But if you deregister for VAT purposes, you need to pay VAT on all the assets that you still have on hand. And now that is obviously an unintended consequence, and that deregistration will now mean that they do not have to account for VAT on the aircraft or the ships or the rolling stock that they have still in South Africa. So it's just to take away that obligation to account for the VAT. As far as Mudarabah financing transactions are concerned, currently they don't fall under the provisions of Section 8 capital A of the VAT Act, which deems certain transactions to be a financial service for VAT purposes, and that will be amended to bring those type of transactions within the ambit of Section 8A so that they qualify as financial services for VAT purposes. Quite an important amendment that has been announced is with regard to non-resident subsidiaries of South African companies. Now, the issue here is that where you supply services to a non-resident, then those services qualify for the rate of 0%. And also, if you supply services to a branch that you have in a foreign country, then those services also qualify for the zero rate under a separate section of the legislation. But where you have a subsidiary company that is incorporated in a foreign country that carries on an enterprise in that foreign country, but that subsidiary is managed and controlled in South Africa, then it's deemed to be a resident for income tax purposes, but also for VAT purposes. So it means then where you render services like management services to that subsidiary, that those management services cannot be zero-rated for VAT purposes. There's no provision in the legislation under which it can be zero-rated, which means that your foreign subsidiary has to pay VAT on those services, whereas it is consumed outside South Africa and it cannot claim that VAT. So that is totally contrary to the operation of a VAT system which seeks to tax only consumptions within South Africa. Now, the Treasury has now recognized that that is an incorrect application of the legislation. We shouldn't tax any services that are not consumed in South Africa. So the proposal is that non-resident subsidiaries, which are deemed to be a resident because they are managed and controlled in South Africa, will be taken out of the definition of resident so that those services can then be zero-rated. I think that is quite an important aspect. Again, just an administrative proposal is where you have entities that manages foreign donor-funded projects or a number of foreign donor-funded projects. The requirement is currently that each of those foreign donor-funded projects must be registered as a branch of the implementing agency. So that means that if you manage, let's say, 50 foreign donor-funded projects, you have 50 registrations that needs to be administered, 50 VAT returns that needs to be submitted on a regular basis and so on. So they're looking to alleviate that administrative burden. Then again, very important in my view, a proposal is that the electronic services provisions and regulations currently apply to all electronic services that are applied or supplied to South African consumers, whether they are registered for VAT purposes or not. So it applies to business transactions as well as to business to consumer transactions. And when these regulations were implemented, we had debates with SARS as to why do you want to tax business-to-business transactions in South Africa? Why do you want to bring in those foreign suppliers into the South African VAT net? Because in most cases, the VAT that is payable is deductible in South Africa. Now, it seems that they have now seen the light, and they have indicated that the foreign suppliers of electronic services will only be required to be registered for VAT purposes if they supply their services to private consumers or to non-resident, non-registered vendors. Another important proposal is with regard to the domestic reverse charge. Now, the domestic reverse charge was brought in to counter the abuse that happened in the second-hand gold market. There were a lot of and substantial refunds that were being claimed, where the allegation is that VAT was claimed incorrectly on illicit gold, Krugerrands that were melted down, notional input tax deductions were claimed, and then when effectively the gold was exported, substantial refunds were claimed, which amounted to billions. The domestic reverse charge regulations were implemented to enforce the second-hand gold purchases to account for the output tax on behalf of the supplier, so that to eliminate all the VAT refunds essentially. But under the current regulations, primary gold producers like mines who are mining permit holders or holders of mining rights are excluded. Now, it seems that these illicit gold tradings in the second-hand gold industry is now moved to the primary gold producers. And the indication is here that they're going to bring in or take away the exclusion of the holders being the primary gold producers, so that there are no exclusions, and all transactions, whether it is from a supply from a holder of a mining permit or any other trade in gold will be subject to the domestic reverse charge provisions. Now, generally, the gold mining companies, enter into arrangement with a refinery to refine their gold on behalf of the mine, which the mine then exports itself. But where it will have an impact is where the mine purchase in material from a group company or from a third party, which it then processes, which it then ultimately provides to a refinery to refine on its behalf. So that is quite a significant impact on our gold miners. The gambling industry, there was always been the Section 72, a special dispensation. As far as the accounting for VAT on transactions on gaming tables of chance, they only needed to account for VAT, obviously, on the net take in respect of a particular period. So that, of course, you don't need to account for VAT on each bet that is placed, but only on the net revenue that is generated after a particular period. Now, the Section 72 rulings were withdrawn at the end of the end of 2021. We applied for that ruling to be extended, which was granted, and the indication is now that that ruling will be incorporated into the legislation to legislate for the implications to account for the VAT. Input tax claims, where input tax claims have not been claimed, you are entitled to make a deduction within 5 years from the date that you became entitled to make the deduction. And normally you claimed it in a current period. The legislation or the proposal is that the legislation will be amended, that you would now claim it in the original tax period where it arose. So the question is, will they then pay you interest on it? And how do you actually practically open those VAT returns? Because generally, if you claim additional input tax, you can't submit a request for correction. So those are practical issues, but the proposal is that you claim that VAT in the original tax period. Again, I think just a fixing up of the legislation, where you acquire book debts on a non-recourse basis, the purchaser is entitled to claim a deduction if those book debts are irrecoverable. But there was no provision previously that if those irrecoverable debts become recoverable, or that if you collect those debts that have been written off, that there is a clawback for that purchaser. That will be rectified to bring into the legislation the obligation then to pay VAT to the extent that debts that are recovered subsequently, that the VAT is then accounted for thereon. Supplies by educational institutions to third parties. It seems that there is some, that they do not know, or there's not certainty as to how do they account for the VAT, and should it be subject to VAT where an educational institution supplies services to third parties. That will be clarified going forward. As far as non-resident vendor registration, including suppliers of electronic services, are concerned, the requirement for VAT registration for a normal vendor that's not a foreign entity is that you must appoint a representative vendor who is a natural person and a resident in South Africa, and you must open a South African bank account. For non-resident vendors, the proposal is that you still need to appoint a representative vendor, but it does not need to be a resident of South Africa, and that you don't need to open up a South African bank account. Those are for the registrations for the non-vendors, non-resident vendors. There's also some doubt currently as to how do you go about claiming VAT that's been overpaid on importation of goods and on importation of services. The proposal is that the Tax Administration Act will be amended to specifically provide for the process that needs to be followed in order to claim back any overpayments of imported services or on imported goods. Because it sometimes happens that you account for VAT on imported services, for example, but the transaction is reversed or a credit note is issued, and then the issue is whether how do you actually then go about claiming that overpayment. Again, as far as imported services are concerned, currently you need to account for VAT within 30 days of the payment has been made to the non-resident. And where you have an entity with various divisions, like a bank, for example, those payments can be made anywhere in any division of that entity. And the problem is to identify those transactions timeously in order to account for the VAT. So the period has been extended from 30 days to 60 days. So those are the amendments or the proposed amendments as far as the budget is concerned. And I thought it best just to deal very briefly with regard to the digitization of VAT. Now, when we had the Davis Tax Committee, at that point in time, it was back in 2015, they commissioned the International Monetary Fund to carry out a study to determine the VAT gap in South Africa. Now, the VAT gap is the VAT that should be accounted for or collected from current economic activities, and the VAT that is actually collected. Now, the study was carried out from 2007 to 2012, and the VAT gap ranged between 5% and 10%. It was 5% to start off in 2007, then it went up to 10% in 2009, and it dropped off again to around about just over 5% in 2012. At that point in time, it was considered, particularly also by the IMF, as being acceptable ranges, because if you compared it to certain European countries, it was actually quite much lower than those countries. So it was considered to be acceptable. But the fact is that 5%, if we take current collections, or even 10% of current collections, it's quite a substantial amount. Now, we will never get to zero in the VAT gap, but we may reduce that quite substantially. And if we reduce it by half, let's say, then we're looking at additional revenue of 10 billion rand to 20 billion rand that can be collected by just improving the collection. So we don't need a VAT rate increase. If we can just improve the collection and reduce the VAT gap by half, we can collect quite a substantial additional amount. Now, with this in mind, SARS has published towards the end of last year a discussion paper on VAT modernization. Now, what this entails is that your whole accounting system will be linked with SARS's system. So as and when you process expenses from your or invoices from your suppliers, that process or that information will be submitted electronically to the SARS system. It will be linked to the SARS system, and the same with your invoices that you issue to your customers. So instead of pushing information to SARS, SARS will be pulling information from your system, all electronically. And your VAT returns will be populated with the information in this regard. So it's not it's not new as far as the international VAT systems are concerned. We have various countries in the world: Argentina, Brazil, Chile, the UK, Czech Republic, Poland, even Uganda and Kenya has implemented this system. And it's all to the objective is to maximize VAT collections and to minimize the non-compliance with the legislation. And in fact, in certain countries, it's a requirement that before you can complete a transaction with your customer, that you must submit the information to the Revenue Authority first, get an approval or an authorization by way of a number that must appear on that tax invoice before you can actually issue that tax invoice. I don't know if SARS will go that route, but that is as the extent to which it will go. Now, obviously, we need legislation amendments. We need a new VAT return that needs to be expanded, because SARS is saying that they will include additional fields for zero-rating goods, zero-rating services, importation of goods, importation of services, etc., to make the information much more accessible and meaningful to review. Now, the issue is here that who will be affected, and how long will it take before we are affected by this. Now, SARS has indicated that they will roll this out first to all the vendors that contribute more than collectively more than 80% of the VAT collections. That means it's all the vendors that are currently on category C that submit their VAT returns on a monthly basis. So it's basically, I think, everyone in this room and everyone that attends virtually as well. It will also be international and multinational entities, and particularly entities dealing with government and supplies to government, and particularly high risk industries that are identified as being of high risk. Of course, there will be a lot of technological research need to be done to make your systems compatible with that of SARS. For SARS to give information sessions for you to understand what is required. The point here is that SARS wants to roll this out within the next 5 years. 5 years goes by very quickly. So even if it takes 7 years, it's still a very short period in time. And the caution is here that just be aware of this, because you would need to, somewhere along the line, you're going to have to budget for this, because there will be an additional cost for redevelopment, redesign of systems to get them compatible with SARS systems. You need to allocate resources, IT resources as well as tax resources. And just be conscious about this, as this will come fairly quickly, I would think. And that one is not caught unawares, so that you are prepared, that this is coming, it will come. It's not just a pie in the sky, so that one is prepared for that. Right, that brings me to the end of my part. I can take questions now if there are, or just afterwards, after Yamal is finished. Right, Yamal, over to you then.
Thank you, Gerard. We generally start our income tax section with a movie clip, but I thought of something much more entertaining this time. So let's maybe see what Mr. Bezos has done. Quite interestingly enough, he announced that he's going to leave Washington State and now become a resident of Miami. Why? Not because he necessarily likes Miami or whatever, but that's now contrary to what is indicated. But by the way, Washington has decided to impose a 7% capital gains tax on sales exceeding or income exceeding $250,000, and Florida doesn't have that. So for some reason he decided it's much better than to go to Florida as opposed to staying in Washington. I'm not sure why, but tax planning is still somewhere along the line, I think, a factor. Not because of the fact that he indicated that he's going to sell 50 million Amazon shares in the meantime. Interestingly enough, Mr. Musk, our friend, our previous South African resident, also decided to go there. Not because necessarily of the tax. I think tax does play a role, but I'm not sure whether you saw in the newspapers that he actually wanted to get his remuneration of about $56 billion approved by Delaware, and the Delaware courts actually threw that out for some reason he doesn't like that, and he decided then he's also going to go to Texas and Florida, because of these type of reasons, that they don't have these restrictions, and also the capital gains tax that they leave it. So that's quite interesting, I think, from a practical perspective. We don't have that problem in South Africa, obviously. Let's maybe look at the numbers. I think to put it in perspective, last year we had the 7% compound annual growth rate. That's now the collections of SARS, and we'll get to that. We actually did a poll with some of you, and you had some results and views as to whether SARS should increase their collection rates. I think SARS last year was much better. This year, yes, 56 billion lower than the budget estimate, but also in the region of about 40-odd billion more than expected in the medium-term budget presentation. So I'm not sure whether you felt it, but SARS was very aggressive these last few months. They collected everything that was possible, and they're still collecting everything that's possible. I expect them to actually exceed the current estimate by about 10 billion. The way they're going on, because there's a lot of money being paid and a lot of assessments being issued, a lot of settlements being entered into. But you can just see it's toned down if you look at that, and it also is an indication of the economy if you look at the numbers and all those type of things. But yes, I think it's much better than expected. Demographics, as indicated, that rate's stable, but if you look at the income tax rates, it went down, but income tax rates are still the highest of the elements of the VAT collection. Corporate income tax has increased. It's increased a lot over the years, but I think income tax is still potentially disproportionate to the other items of income tax. Once again, Gauteng is just, on the shortest straw, drew the shortest straw, 38%, and actually paying the most taxes. And then with the bracket creep, as Annabelle has indicated, is going to be much more, the 25.6% in this category, in this bracket of 35 to 44, and that's really where the people are paying tax. Female, sorry, you're just losing out again yet, but you're increasing. It's 48% to 51%. But that percentage is increasing over time. So it seems that the female population is much more active than the men for some reason or another. And yes, there's a lot of people that are being assessed on new registrations. On this one, I think, and that's also indicative of what's happening in the SARS system. If you look at the complaints that were received, last year, 61,000, this year 115,000. So it almost doubled or more than doubled. So it just shows you the dissatisfaction or the problems that's experienced with the system. And I think it's a system mostly because you can't speak to somebody at the other end. You've got the call center, you have sent something in the air, you don't know whether it will be received, or whether somebody will look at that. And that's an indication of the problems that we have with reference to the system that we have. Rulings issued, I think, is also an indication then of the economy. Rulings went down as opposed to the rulings that were issued the previous year. And it's an indication of, I'm not sure whether it's taxpayers not supporting the SARS, because I think the rulings division in SARS is probably one of the best run of the SARS divisions. But I think the issue is an indication of there's not really that corporate action where people need to get that certainty from a practical perspective. Yes, we've got the complaints. And then interestingly enough, these models of SARS, the verification issues and so on, they detected 26,000 people with an income exceeding 1 million rand. And then 1,000 of them involved in money laundering. So those type of systems do work from a practical perspective. High net worth individuals, 20 cases initiated. So yes, that division is actually looking at all of you, by the way, as Gerrit has indicated. So don't be too comfortable or too Gerrit, James, you don't need to go, it's fine. And then the VDP applications continuing to generate cash, the 3.3 billion. So yes, I think it's an important element and a source of revenue generation over the years, even though there was some reluctance initially to implement and introduce the VDP system. Now on appeals, and I think that's also an indication that's maybe concerning. Just maybe to give an indication, if you look at these statistics, you've got an assessment, you have an objection, you've got a disallowance of objection, you have an appeal, and then you go to ADR before you go to the tax court or the tax board. Now, if you look at these, appeals in ADR increase substantially. If you look at 6,000, 7,000, now 9,300. It's a substantial increase in taxpayers disputing their assessments. Appeals in ADR above 1 million, 495. It shows you that these type of assessments and the disputes mostly relate to issues below 1 million rand. And if I'm not sure whether you saw today, it was announced that there will be a new process that's being implemented. That is that you also potentially have an ADR after the objection phase. So you may actually have now an assessment, objection, ADR, depending on whether that's successful, appeal, maybe another ADR, and then a tax court or the tax board. Because most of the matters, believe it or not, are resolved somehow or another, and we'll get to that, who's conceding what, during the ADR phase, as opposed to tax court or otherwise. If you look at that, remember this number, 9,379 in ADR, and then the total number of new appeals, over 10,000. It's a substantial number of appeals that you have. Appeals in ADR below 1 million, 95%, above 1 million, 5%. It shows you the comparison and the issues concerned. And it's not that many matters that are exceeding the 1 million mark if you look at the dispute process. Rate of inflow of appeals, 25% increase. Disputing, taxpayers disputing that, exceeding the rate of finalization, 6.6% reduction. So you actually have more appeals coming in and not so many appeals that are being finalized. So that's why the moment you get into that system, you wait. SARS really, to a large extent, never adheres to those deadlines that they have to respond to you or disallow an objection or whatever the case may be. There's a special project now to review and finalize the appeals, but once again, I think it's really an issue that you still have to wait because there's not really the manpower. There's a very small team in SARS responsible for the ADRs in excess of that. Resolution reached for 67% of the cases, with 27% referred to the tax court. Now, if you look at that, these statistics, SARS now concedes, if you look at this, 27% of the cases in excess of. So it's not, the tide is actually turned. You know, last year, I'm not sure whether you remember, we said SARS basically won all of their cases. The tide has turned. The tide has turned, so it's some good news for taxpayers. SARS concedes 27%. Partially concedes 20%, taxpayers withdraw 9%, and then settlements only 11%, and then refer to the tax court 27%. So there's a substantial element of concession on the part of SARS if you look at these cases. Interestingly enough, when does SARS concede and when does the taxpayer concede? SARS concedes mostly at the ADR level, whereas taxpayers withdraw it at the tax court or the tax board level. But when the matter goes past ADR, you must know SARS is probably going to take you on and probably win, depending on the circumstances. Interestingly enough, if you look at the tax court decisions, it's actually 3%, 3%. So it's more or less even as opposed to 100%, 0%, or 99%, 0%. So it actually made a difference. Exchange of information, 263 cases. 141, at least there is some issues pertaining to state capture and those type of things. 336 reportable arrangements, mostly preference shares. And then overall, depending on the circumstances, how you count that, including the concessions, 87% as opposed to the 100% on the part of SARS. Focus areas, what are left? What issues are left? The abolishment of Practice Note 31 is still a big issue, even though the legislation has been promulgated. The issue really is that, to a large extent, interest is as defined in Section 24J. So to the extent that you receive interest, you can deduct it up to the interest that you generate. So you can deduct that so as long as it's linked. Previously, in terms of Practice Note 31, the issue is you could just deduct it arbitrarily to the extent that the amounts match. Now you actually be able to show that the amounts are in that generation of that income, or the interest would be in that generation of the income. Coronation case, yes, it was heard. So it's very interesting because it's interesting for two reasons. Whether or not those of you that have those foreign subsidiaries, whether they have a foreign business establishment. Apparently everybody is quietly confident, SARS and taxpayers, so we have to see. but also on the penalties, because penalties, Coronation and Thistle Trust, if you have an opinion, basically the courts have indicated that you don't pay understatement penalties, and SARS is very unhappy about that. If you acted in good faith. And those issues are also being debated, because at this stage, the Supreme Court of Appeal indicated that to the extent that you have these opinions or you acted in good faith, then there's no understatement penalties because it's a bona fide inadvertent error. Two-pot system, effective 1 September 2024, the 1/3 savings and the 2/3 retirement. I personally think there's only one element of our community that will be ready for the two-pot system by 1 September 2024. It's not going to be the insurers and the pension funds. It's those people that want to withdraw their money from the from the cash pot, the savings pot. And they are going to queue, and the insurers and the pension funds are going to say, sorry, our systems are not ready yet. And that's been the one issue, because it's been a political issue. They indicated that originally that they're going to postpone it by a year, and I think because of the elections and the thrust on the part of the labor unions, they actually now indicated 1 September. I personally have my doubts, but let's see, because it's very complicated, administrative cumbersome, so we'll see whether or not they're ready. But there's going to be, I bet you, there's going to be a lot of people wanting to withdraw their money from the savings account from that perspective. Pillar 2, it was announced this year, and by the way, it's not G and T, gin and tonic. It's not that, it's GMT. So very important. The tax bill was released today. Global minimum tax, GMT, not G and T, but you can remember it that way. Pillar 2, for the large multinationals, MNEs, and sorry to the merchant bankers, but I also experienced it again this week. If you don't use the slang of merchant bankers and abbreviations, then you're not part of that community. So you need to know this type of slang in the context of this Pillar 2. You need to know the income inclusion rule, the IRR. You know, you don't need to know anything about it, but you just need to throw it around. IRR, income inclusion rule, because that really effectively helps the South African entity, and that's really what South Africa is relying upon. It's a South African holding company that can actually levy that tax to the extent that the 15% tax was not paid in the foreign jurisdiction. So that's really the thrust. You don't want the foreign jurisdiction like Caymans or Mauritius and so on to levy the tax. You want the tax to be collected here. And that's what the IRR is all about, the income inclusion rule. Under tax profits rule, that is if, to the extent that South Africa doesn't collect it, then there's that. But all the countries mostly have said, okay, we'll postpone that type of thing, because we don't want to give the tax havens the right to collect the taxes. So you effectively have a 15% effective tax rate. Yes, consolidated revenue, it's very complicated, but it's really accounting starting point at least of $750 million, and then you go down from that perspective. And yes, the minimum tax of 15%, ensuring the host company to retain the taxing rights. And that's really where South Africa thinks that it will collect more money. Yes, but if you can actually then cut through the income inclusion rule on the under tax profits rule and say, okay, I don't want that, it's just a domestic minimum tax of 15%, and you, to a large extent, achieve the same result. But that's now the DNT and the UPRT and all those type of things. So just use those type of abbreviations, and then you know what, then everybody will be impressed. But to a large extent, that's the issue. The principle is 15%. If it's not collected overseas, then the South African holding company is going to pay that. And yes, as I said, it has been released, that bill today, the draft bill for comment. We had, and I said, we very knowledgeable people that commented and actually participated in our LinkedIn poll. We'll just see now. The first questions, we asked 3 questions. Do you think taxes should be increased? And yes, no. Yes, 3%. No. The collections must improve 80%. And what happened? Actually, collections were improved. So it shows you that you know what you are answering and know what you're doing. Which tax policies and tax incentives do we most? Extend learnership allowance? Yes, by 3 years. So that's a good thing. Expand the GREET incentives? Yes, the motor car manufacturers from 1 March 2026 can get this additional allowance on their EVs, once again, electric vehicles. You know, you must remember and the production of that. So that's an incentive because that's the move towards the greener economy and all those type of things. And that's really what you also answered that. You say this is what must happen. The only thing that's unfortunately not happened, the WFH, what's that? Working from home. You need to know these things. Sorry about that. There's no additional centers for that. That's the only thing that I think that people expected or wanted to, even though they knew it was not going to happen. But yes, there's nothing on that one. Should the government introduce tax incentives for electric vehicles? Yes, and that was also what's being implemented from a practical perspective. So if you look at this, revenue collections did improve since then what was expected September to now, 45.6 billion. As I've indicated, I think there will be more. Learnership tax incentive extended by 3 years. Local electric vehicle production, 150% on your qualifying investment. So, people like these new additional investments. By the way, I'm really sorry about that. Your deadline of the end of February for your personal solar still exists. So you've got how many days? 8 days left. At least you have an additional day this year. And for the corporates, it's not to ask your girlfriend out or to marry, or the girlfriend to marry. You can actually then implement your solar system there at your house. And then for the corporates, it's next year. So they haven't extended that. They did extend it for the 12B ones and some just to make it a bit more palatable in the context of what we have, but it's not really that much of an incentive or the extension of the incentives. And then no incentives for the work from home. What happened? Employment tax incentive, and that's a big one. I'm not sure which of you have been involved in that, but I must say most of those which I've seen really involve a scenario where you've got this promoter undertaking towards the corporate or the employer, we will train your students. So the corporate then signs 1,000 employment contracts, never see the students, don't know what's happening with the students, don't know whether the students will get some training. The students, let's say you're involved in the gold sector, the students will get marketing experience or whatever. It's nothing related to your business. And you just claim the incentive. Now, most of the companies then made the profit from the incentive. There's a couple of companies that stayed afloat that way, by the way, and didn't make money from their normal operations. There have been a number of corporates that entered into these schemes based on the representations of these promoters, unfortunately, and they've been caught because there's, at this stage, I think it's over 600 cases. There's a test case coming. And you don't want to know how much trouble there is and monetary woes those companies have now pertaining to those incentives that have been claimed, because to a large extent, the principle, and it has been amended to say the principle is that the student must at least be employed by you, and because of this abuse, they're going to announce more penalties from a practical perspective. So don't get into that unless you're sure that you're actually employing them. That's really the message, because the punitive measures are really disastrous. You have to repay that, interest, penalties, all those type of things. So be very careful before you get into and venture into these things and be persuaded by these marketing and promoters that sell these type of schemes. So be very careful from that. That's the message on, I think, the single, because most of the companies and corporates that we have dealt have actually invested in these ETI schemes, and unfortunately the chickens have come home to roost now. So I want to be very careful in relation to that. So that's the message on that. Now, this is the part where I have to apologize. My wife was actually the only one that promoted this problem and identified the problem. And that's to a large extent in your private equity investments or the banks entering into investments, because they do that through means of partnerships. And because you're a partner, you're now a connected person with reference to all your other investors in relation to this investment. And because you're a connected person, everything must take place at arm's length, and there's anti-avoidance rules and all those type of things. And in my example, if a Standard Bank and a Net Bank, they don't even know what they're doing because they're partners, but they're connected persons. So there was a submission that was made that the legislation should actually consider this and exclude it, especially, and they've indicated now that they will actually exclude it in the context of limited partnerships, income and deed partnerships, and silent partners. So, sorry, Lavi, I apologize. I never thought that the legislation legislature would accept this proposal because of the consequences that would happen. So that's what's going to happen there. Assess losses. Also very interesting. Currently, we have the 80%, 20% rule. So to the extent that you have an assessed loss, you can essentially only use 80% of your taxable income. You're going to pay tax on your 20% of your taxable income. And you just carry it forward. So you're going to pay tax even though you may have assessed losses. That's really the principle in Section 20. But however, there's been problems to the extent that the company is liquidated, deregistered, or wound up. And now from those perspectives, this rule may now be relaxed, such that you can use your entire loss to the extent that the company is liquidated or deregistered, as opposed to having to carry it forward because there's nothing to carry it forward to because the company is no longer going to be in existence. So that's really a good thing. And I think mostly we have good news in the legislation as opposed to bad news and the proposal. So this is one of the good things that was in fact proposed. Rollover relief, once again, I think it's good news. Especially in the context of intra-group transactions. You may have subsidiary A, subsidiary 2 that enter into an intra-group transaction, and then you have this immediate holding company, you've got the intermediate holding company, you've got an ultimate holding company, and you've got the 6-year rule. And nobody knows what group is actually concerned, and when do you actually have this degrouping charge? Basically, your assets being sold at market value to the extent that this smaller group is now sold to another entity, or you change it within the group and all those type of things. But it's now been appreciated that to the extent that the value remains the same at the holding company level, value shifting firstly will not apply, because mostly whenever you do transactions at the group level, you do that at book value and not market value, because you don't want to show artificial profits. So the first issue is that you can now sue it because it's an holding company, you fall within the group, and on that basis you don't have a value shifting problem because of the fact that you may do it at book value and the shares change and all those type of things. So that's the first good thing. And the second good thing is the 6-year one, where so as long as where there's a change in shareholding affecting a group of companies, where the companies involved in regional transactions still part of another group of companies. So if you have that group, the legislation will be introduced to make it clear that you don't have this degrouping charge, because the key issue is really the transferor and the transferee, and whether they're part of the group as opposed to the intermediate and the ultimate holding company and that type of thing. So that's also been accepted. Now for the bankers amongst you, because we always have to have news for the bankers. Some good news, I think, and mostly good news. Some consternation when 8A was amended with reference to the fact that on third-party backed shares, the operating company or the investment in the operating company must be retained for the duration of the funding. Now, 2 relaxations. Firstly, the exemption to corporate actions pertaining to listed shares with foreign exchange. So that's also now extended to that you don't have the consequences. And then also that you can use the proceeds to pay dividends and all those type of things within 90 days. So that's now been made clear that you can use those proceeds for that purpose. So that's really the good news associated with that. But the enforcement right now also extends to potentially a connected person. It's not only the holder of the share, it's also then whether or not a connected person may actually have that enforcement right. So that's maybe something that one should consider, because there's been a number of transactions where a connected person may have had the right to buy the shares and all those type of things, as opposed to, or the right to have the shares sold, or some compensation potentially, as opposed to the holder as such. Equity-linked notes, also something for the bankers. There's always this debate on Section 24JB. How does that interact with the rest of the provisions of the Income Tax Act, specifically gross income? And the example arose last year again when a ruling was issued, when the question arose if a bank receives money in terms of an equity-linked note, because it's very popular. The bank issues an equity-linked note, and then over time, there's no accrual even for the investor, and only at the end an amount is paid to the investor. So the investor then holds it for a 5-year period, and sometimes the bank would guarantee the proceeds. So for individuals, it's a good investment in the sense that you get the exposure to the equity markets, or those that you actually want to, and you get this equity-linked note as opposed to having to buy and sell shares or having to invest in a CIS. For the bank, however, the question was always this initial amount that was received by the investor, is that gross income, because it's not dealt with in terms of Section 24JB, and it's now made clear to say Section 24JB, that's the section. The gross income, other sections would not apply. That prevails over the other sections. So I think it makes clear that it's really the accounting treatment that's now important, and that's the way you need to implement. So I think it's a big thing, not only for equity-linked notes, but also other transactions entered into by banks, such that you can know that it's really 24JB that ranks over all the other provisions, except to the extent that there's limitations like 8F and all those type of things. So it's quite important, I think, in that context, that that's really the system. So banks are really in a different tax system compared to other entities, because they're the covered persons from a practical perspective. Ancillary issues, very interesting. I'm not sure whether you recognize that, but there's a trend and a decision to promote infrastructure in South Africa because of the problems that we've had. And one of the issues is really that for investment vehicles, sometimes you invest it through means of a special purpose vehicle and all those type of things. They're thinking of introducing a principle that the conduit element will apply. So instead of the allowances being trapped in the SPV level, it goes through to the investor. So the investor can actually then claim those allowances, as opposed to it being trapped in the, otherwise you have to make use of that partnership that we mentioned, or a trust and all those type of things. But even in the case of a trust, you can't vest losses and allowances in beneficiaries. You can only vest benefits in beneficiaries as opposed to losses. So that's one of the things, that if you make this investment, that you can actually claim it as the investor, as opposed to it being trapped at the SPV level, which is in between. Because mostly you want that for liability purposes and all those type of things, that you actually do that. Renewable energy may be relaxed with reference to the generation threshold leasing restrictions, but that's only from next year once again. But I don't think it's that much of an issue. The big one for corporates is still the same, and 1, 2, you've got the deadline of the last day of February next year that you have to invest. Then a very important issue, which I also think is quite surprising to most taxpayers, but it shows you the influence of pension funds and their investment in South Africa. Because if you look at Section 23N and those type of provisions, if you were a pension fund, you make an investment in a venture and you control that, then the problem is if you make loans, the investment can't deduct the interest because of the fact that it's exempt. And 23N was originally only envisaged to cover non-residents and so on, but it also now extends to exempt entities within South Africa. So the problem is those entities don't want to make an investment anymore, the pension funds, which will result in them controlling these type of entities, because that will result in the interest no longer being deductible, or you have this formula to determine the extent of the deductibility. So that's a huge problem for investment as such, because the moment you get into that controlled scenario, then the interest is not deductible, and you can't fund these entities through means of interest as opposed to equities. And in most cases, people don't want to fund it through means of equity. So that type of thing will now be relaxed to the extent that it's made to control South African entities. And I think it's really a big thrust such that those investments can still be made because there has been some reluctance on the part of the pension funds and other exempt entities to make these investments and to make loans to their controlled entities because of the fact that the interest would then not be deductible or only partially deductible. So I think that's also quite an important thing, where control can still be exercised as opposed to a minority interest being held by the pension funds. So I think that's also quite an important issue that have been given. Anomalies for exchange gains, that's also, once again, good news. If you look at Section 24I, companies have to include their unrealized foreign exchange gains and losses whether or not they're trading. So anywhere year one, there may be a huge loss because of the fact that the rand has declined vis-a-vis the other currency. So there's a loss for that company. So it's got the loss, and you can claim the loss. Now, in the second year, there's a profit. But in the second year, you can't claim and set off that assessed loss that arose in the first year against the profit because of the 80%, 20% rule, which I mentioned. So the problem is now you actually pay tax on unrealized gains, but you can't use losses that have been generated for that same purpose. And what they're intending to do is to ring fence that, to say, yes, look at those on an isolated basis, combine them such that you can at least utilize that loss to the extent that there's profits going forward in respect of your exchange items. So I think that's also a good thing, because there's always been this issue, you make the loss, or you make the profit in a 1 year and you make the loss and you can't use the loss. And I don't think the legislation will be such that if you make the profit in the first year, you can use it against the loss in the second year. You still have to pay your tax in the first year. It only helps you if you have a loss in the first year compared to the profit in the second year. But at least it's something, I think, from a practical perspective. Exchange control, yes, once again, we have some relaxations on exchange control. And I think the message is really that more authority is granted to the banks and the authorized dealers. That they can make the decision as opposed to one having to refer a number of applications to the FinServ, the Financial Surveillance Department of the South African Reserve Bank. So to a large extent, the message is really that banks and authorized dealers have the authority to decide. The first one is really unlisted companies operating in the fields of technology, media, telecommunications, exploration, other research and development. That's now unlisted companies may just apply to the bank to invest up to 5 billion rand per annum. So if you're in those fields and you want to invest, you don't have to go through that process of having to submit the application to FinServ and those type of things. If you're an unlisted company, you can just submit the application to the authorized dealer of your choice, obviously. Private equity funds that are licensed, once again, can invest up to 5 billion rand, subject to the bank having made that consent and considered the application and made the approval. So once again, you don't need to submit that application to the Reserve Bank. And then much more discretion in relation to export proceeds, import payments, those type of things. From a practical perspective, that's really for the authorized dealer to decide, because there's always these problems and delays in relation to the import and export and all those type of things when it has to be made. So overall, I think a good budget. The message is good. Yes, we have the bracket creep type of problem, but I think generally the submissions that have been made have been heard. Problems have been addressed. There's no real new taxes. There's incentives for infrastructure and investment, and because we need that. There's here and there a problem associated with some type of transaction that's been entered into, but I think generally it's a positive message that has been sent, at least from a tax perspective. So from an economic perspective, it's good. Gerard, from a VAT perspective, it's good. And income tax is also not too bad. So thank you so much. We really appreciate that. As I've mentioned, there's some drinks and something to eat there at the back, just to, once again, for you to compose yourself after having to listen to this for an hour and a half. And thank you very much to the marketing team and everybody that actually put in a lot of effort to set up this whole presentation and infrastructure and everything here. We really appreciate it. It's quite professional, so thank you so much. We really appreciate it. And thank you for coming and everybody listening via electronic means. We also appreciate that, and we want to see you again at some stage. And I've actually spoken to Gerard, maybe we should actually have more of these seminars because everybody seems to be enjoying it. And thank you so much. See you just outside. Thank you.